Quick introduction. My name is Mark Lamonica. I look after the individual investor team here in Australia for Morningstar. And I need to go through a couple of housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, you can go to our website, morningstar.com.au, to get a copy of our FAP. And also the New Zealand regulatory authorities would encourage you to go speak to a financial advisor if you want personal advice. All right, so as I said, today we're going to talk about how to determine how much you need for retirement. But a couple logistics, we will send out an email to everyone who is registered for this after the session. That email will have a recording, and it will also have the materials that I'm going to go through today and a couple links with things that I'm going to talk about. We are building off of a webinar we did last week. So we are doing for the next now 7 Tuesdays, including today. So we have this 8-part series that, at least I think, teaches you hopefully everything you need to know to gain a foundation being an investor. So we talked in the first week, we talked about goals and how to determine goals. And one of the things that we stressed during that session was that in order to define a goal and then get everything you want out of it, which we'll go through in future weeks, you really need to be very specific about that goal. And one of those things is defining when you hope to accomplish that goal, how much that goal is going to cost, and of course, your personal things, how much money you have, how much you can save and invest to reach the goal. But that how much the goal will cost can be very tricky when we're talking about retirement. So coming up with that estimation. So that's what we're going to spend today doing. And this should be relevant for everyone, whether you're trying to estimate what your retirement will be when it is years and years and years away, or as you're approaching retirement, or even as you go into retirement, because we're going to talk about withdrawal rates today and how you turn that portfolio into your day-to-day living expenses. So that's what we're covering today. I would love questions. So you can ask questions through the Q&A. You can send them through the chat if you want other people to see your questions. Or, of course, you can email me at mark.lamonica1@morningstar.com. That is the email address that's in this Zoom invite. All right. So let's get going. So as I said, that's my name. That's what we're covering. All right. So as I said, this is lesson 2. So we started with this goals-based portfolio construction, which I just briefly recapped, talking about how to estimate. And next week, asset allocation, which is always exciting. All right, so we're going to go through a couple different things today, and we are going to reference a lot this Morningstar State of Retirement report. So that's a report that Shani wrote, which I think is very good. But once again, I'm biased. But we'll send a link to that report in the email that we send out later today, hopefully. Okay, so why do we define goals? And anyone who attended the first session should hopefully remember this slide. And, well, why do we refine it? Why do we define them? Because we need to know where we're going as investors in order to figure out the best way to get there. And that's going to be particularly true as we go through webinar 3 onwards, where we talk about asset allocation. What is the mix of assets that will allow you to achieve your goal? And then how do you select investments? So that's when we start getting into individual shares and funds and ETFs and what you're actually looking for when you're picking those investments. All of that is based on your goals. That's why we think it's really, really important to define your goals. And the first step is, how much will your goal cost? So we went through this a little bit during the first session, but that's very easy if it is a certain amount of money, like if you're buying a house, for example, and you know you need a certain amount of money for down payment. People have problems coming up with this for retirement. And the number one problem is that we of course, spend our entire lives getting a salary and using that salary to create a budget and pay for our day-to-day expenses. Well, we now have to translate that annual amount that we receive in a salary, or weekly or monthly, or however you are defining that, into a lump sum. And this lump sum is supposed to support us for the rest of our lives. And as I said right here, that lump sum needs to translate into an acceptable annual income to support you and the lifestyle you want. And it also needs to last until your retirement ends. And the tricky thing about your retirement ending is that, of course, is your death. And nobody knows when they're going to die. And I'll say this multiple times today, to be a little bit morbid, but I'll say this multiple times. If we knew when we were going to die, retirement planning would be very easy. Problem is we don't. So that is the challenge that we are going through today. All right, so let's talk about how to estimate how much you need for retirement. Then later, we'll talk about how to make it last, which is, of course, this challenge with death. We'll see how many times I say death today. All right, so what do we actually have to do? What are we going to go through? We're going to go through two things initially. So first step was this lump sum needs to translate into an acceptable annual income. So what is an acceptable annual income? So we're going to talk about something called the income replacement rate, which is a little bit self-explanatory, but we'll get into it. There's some nuances. And then this death thing. How does your portfolio last until your death, which is an unknown date? We need a safe withdrawal rate. So we'll talk about what that means. And if you can calculate or estimate these two things through the power of very simple math, you can come up with a lump sum that you need to support your retirement. All right, let's talk about this income replacement rate. So all we're doing here conceptually is we are thinking about a paycheck. It can be your current paycheck. It could be an aspirational paycheck. It could be a paycheck that occurred at some point in the past. Either way, we need to think about what is the monthly, annual, however you want to define it, amount of income that you need to live on. And an easy way for people generally to do that is to think about what they live on now or what they foresee themselves living on in the future and taking a certain percentage of that, which is what they're going to try to replicate from their retirement plan. So you guys can all read the definition here, right? The income replacement rate is a percentage of your annual pre-tax employment income that is replaced by retirement income. All right, so very, very simple example here, $100,000. And if you need $75,000 a year, that's 75%. That's your income replacement rate, is 75%. Now, there are three factors that are going to influence this. And those three factors, as you can see, that are bolded on this slide are how much you're currently saving, how much you pay in taxes, and then lifestyle differences in retirement. So let's go through each one of these and a good way to estimate them. Okay, so number one, we need to start thinking about savings and taxes. And why do we have to think about that? Because your savings and taxes are different in retirement. Now, once again, everybody is different. So I can't make a broad assumption, but depending upon super, how much you have in it, how much you want to take out, all sorts of different personal tax situations that you need to obviously think about yourselves, you're generally paying a lot less taxes or potentially no taxes in retirement. So a good way to take a first step at this income replacement rate is to go to paycalculator.com.au. So Shani told me earlier today, and she's actually told me a lot, that this is her favorite website. She, I believe, said it was her ride or die, which I thought was a lot for a website that calculates how much of your paycheck you take home. But if you've never been to paycalculator.com, very simple thing is you throw in whatever salary you make or you want, and it'll tell you how much is going to go into super and how much you are going to pay in taxes and how much, of course, you take home. Now, why do we do that? Well, we do it because taxes, of course, differ as you make more money. So a marginal tax rate means that we are all going to pay different percentages of taxes depending upon our salary. And we'll get into the implications of that in a second. So I put in $100,000. So the example that I used before, $100,000 into paycalculator.com. So what this is showing me is that after superannuation and after the taxes I pay, I am going to take home a little over $70,000 a year. Now, once again, everybody's tax situation is different. Everybody's savings is different. So this obviously only equates to mandatory super contribution. So you could be saving more. You can be saving more in super. You can be saving more outside of super. So do this with all of your savings. But this is going to show us, okay, what am I actually living on? So what is in my take-home pay? Well, in this case, your income replacement rate, if you simply needed it to replace your current income, is 70%. So that's a good thing, right? So you've already chopped off 30% off your income. We've got a couple questions. Let's see. Yeah, so John is saying, does this include the Medicare levy? There's a setting in there that you can go through, and so you can include anything. And the other thing is, yeah, I actually got a message from Shawnee saying, remember the Medicare levy and HEX, of course. If you're paying HEX, for example, you can put all of that stuff in. You can put in different salary sacrifice amounts into this website. Just go to the website. It is very helpful. Shawnee, I'm sure, uses it when she's looking for other jobs and imagining how much salary she will have with those other jobs. So yeah, I put a very simplistic example in there, but go through. It is obviously set up for Australian taxes and everything else associated with paychecks. So the question is, why is the taxable income 90 and not 100K? So what they're doing is they're taking out that super, right? Yeah, Lisa's saying it's amazing how 30% of income is immediately accounted for super and tax, but it's good. It's good when we go through this replacement rate. All right. So the next step that you need to do, of course, is adjust your current pay to estimate any needs for the future. All right. So there's a couple different things that you need to look at here. So inflation. Now, inflation is always an interesting one. Your salary will, of course, not necessarily grow with inflation, but if you're trying to estimate this as somebody that does have a number of years to go until retirement, you can put in, obviously, some sort of figure in there to account for hopefully making more money in the future. And obviously this varies person to person, but a simple way to do that is you can use our portfolio projection tool, which generally we use to project portfolios forward. But you can also use it with any return. You get to put in whatever rate of return you want. So put in anything you want, how much you think you will potentially grow your salary over the years. One thing you can do as kind of a default, if you don't really have a good way of estimating that, is put in just an amount for inflation. Your assumption, of course, is then your salary will grow by inflation, which means in real terms, it's not growing at all. So that's something you need to do, particularly if you have a ways to go until retirement. The other thing is realize that because of marginal tax rates, so what is a marginal tax rate? It basically means that as you hit different thresholds, you will be taxed more on the money that's above that threshold. The good thing about this, if you keep making more money, and obviously tax rates can change, keep making more money, it means that your replacement rate will actually go down as you make more money. It's because you're paying more taxes, so maybe that's not a good thing, but as you make more money, that replacement rate will go down, and that will, to give you the same lifestyle, that will, of course, adjust the retirement savings you need down. So remember that. And once again, tax rates change, but you can go into that, like the joke I made about Shawnee looking for, I hope it's a joke, looking for a new job. You can go into that calculator and, of course, try out different numbers, and you'll see that that percentage is actually going to change. All right, so do that. What do we have? We have one more step to make. Many people's lifestyle changes in retirement. So why would this happen? Well, some people move during retirement, so it's not uncommon for people to move to a lower cost location. That could, of course, change the amount of your salary that you need to replace. A lot of people pay off their mortgage, so think about that as well. If you are trying to pay off your mortgage by the time you retire, and you're thinking about your current salary, and like many Australians, if a lot of that goes to housing, well, all of a sudden that disappears. Doesn't completely disappear. You'll still have other stuff you need to spend on your house, but a lot of that goes away. There are different spending plans in retirement. Simple one that you always hear is maybe you spend, and I don't think a lot of people are commuting now, which is why this whole building's empty, but You may spend money on commuting. But the other thing is think about how your spending patterns may change in retirement. Typically, what happens is early in retirement, we'll talk about this later, early in retirement, people spend a lot more because they're more active, because they have more time to travel, they have more time to maybe go eat out, things like that. So think through how you expect your lifestyle to change. And remember, this is just an estimate. So think through that. And then are there additional sources of income like the age pension they can draw on in retirement? Now, how would the age pension work? Well, if I'm sitting there and I'm trying to replicate a lifestyle where I make $70,000 a year after taxes, after super, and that's the lifestyle I want to replicate, well, if you're getting $20,000 a year from the age pension, you can knock it down to 50. All of a sudden, your replacement rate becomes 50,000 or 50%. You got to think through all of these. Now, obviously, these are all very personal. Some of these are estimates, but either way, going through this exercise is obviously better than not going through this exercise. So we talked about this last week that, precision is the enemy of progress, right? Like make estimates. It is better than not going through the exercise. All right, so hopefully this will give you a replacement rate. So let's use an example. All right, so what I did is took $100,000, said I have 10 years till retirement. My salary in this scenario is going to grow 5% a year, so pretty good. What would that be? I'd make $162,000 in retirement, or as I retire. So that'd be my income going into retirement. So I put this into salarycalculator.com. It tells me, gives me a provision for taxes. It gives me a provision for savings. So this is simply super. I've decided that every year I will have $4,000 reduced expenses for whatever reason. Maybe that's my commuting costs for a year. I don't have to do that anymore. And I have decided, or I've figured out that I'm going to get $10,000 from the age pension. So what do? Gives us $91,000. That gives us a income replacement rate of 56%. All right. So hopefully that was clear. We've got a couple of things going on in the chat here. Shani's answering the question for me. Shani says, fun fact, today is Paul Keating's birthday, and he is credited as the architect of super. Okay. Well, thank you for that, Shani. I'm sure people appreciate knowing that it's Paul Keating's birthday. All right, what else do we have? A couple of questions up. Got those. All right, so let's move on. Let's move on to our next step. Now things are going to get a little more complicated. So we're going to talk about a withdrawal rate. So as I said before, after a lifetime of earning a salary and using that salary to pay for your life, now we have a pot of money, and that pot of money has to last for the rest of our lives. And if we think back on what has happened, so globally this has happened. If we think back to Australia, as we've moved, as Shani just said, talking about Keating and superannuation, as we've moved from a pension paying for everything in retirement to superannuation, what of course is that doing? That's shifting the burden to you. So it is now your responsibility to figure out how much you need to save to support the lifestyle you want in retirement, and then, of course, not run out of money. So this is the biggest challenge, as I said before, in the deaccumulation phase. Spend our whole lives accumulating assets. Now we are deaccumulating assets, but we don't want them to run out. And there are two risks that we face that we're going to spend a lot of time talking about as we retire. And those two risks are sequencing risk and longevity risk. So, and these both impact the fact that we need to sell assets in retirement and use those assets to pay for our life. So, sequencing risk. Sequencing risk is the risk, and we'll go through these in a little more detail, that you retire and you immediately face terrible market returns. And this is a very bad thing, which we'll get into. And then there's longevity risk, and that's the risk that you outlive your money. So that, of course, is the problem with retirement. It's a bit of a zero-sum game. You either outlive your money, which is a bad thing. Once again, you better hope your kids or somebody takes you in, or you don't. And this is complicated by the fact that we don't know when we're going to die. Let's talk a little bit about sequencing risk. And we've got what I think is a very good example. As I said before, the order and the timing of your returns matter, not just the average. We always think that the average return matters because we're conditioned to think that way over the accumulation phase. Well, you're saving and investing. What matters to you is, of course, the average return you get if you're a long-term investor, average annual return. That is not true in retirement. If you have the bad luck, that's what sequencing risk really is bad luck to happen to retire into a negative bear market. It has very, very negative impacts on your retirement savings. So we have two different scenarios. Scenario A and B. So both of them are 20-year periods where we start with a $500,000 portfolio. We invest in the S&P 500, the 500 biggest US stocks, and we take out $20,000 a year in withdrawals. So what are we saying here? So we're saying we're taking 4% of our portfolio out every year, like many retirees. So we're saying that we have a set withdrawal rate, we're taking $20,000 out a year. And this is our portfolio, and we want it to last for 20 years. All right, so scenario A, we looked at actual S&P 500 returns between the year 2000 and 2020. So for those of you that remember a little bit of market history, 2000 was a very, very bad time to retire. So we have the dot-com crash that happened. Also, of course, in these 20-year period between 2000, 2022, or 2020. We also had the GFC, all happening in that first decade, if we're looking at that, looking at 2000 as a retirement date. So not a great time. So what happens in this scenario where you're taking out $20,000 a year, the rest is invested in the S&P 500. So you end up with $165,000 at the end of the period. In scenario B, we took the exact same returns and we just switched the order, right? So the return you got in 2020 is in 2000, et cetera, 2019, 2001. So all we did was switch the returns. So it is the same average, the same returns over 20 years, just switch the order. In this case, you end up with $782,000. So this is a huge difference, if that's not obvious to everyone. And the reason for this is the sequencing of returns. That in this case, scenario A, this retiree had the misfortune of retiring into a very, very bad bear market. Then, 7-8 years later during the GFC, was hit with another very bad bear market. Not good. This person, returns have been very strong since the GFC. This person retired into an environment where they had a long run of very good returns, and then returns started going south. And the reason that sequencing risk is a detriment because you are taking money out of your portfolio. So you're not doing that during the accumulation phase, hopefully. So in these examples, the problem is the market falls a lot during 2000 and you're pulling money out. And because you're taking the money out of your portfolio, you don't have the chance to profit from the recovery in the market. So in those early years, thinking about the first decade of your retirement, in those early years, while you're pulling money out, you're not going to get that money back because when the market does go up again, you have a smaller base, of course, invested to take advantage of those positive returns. So yeah, this is a very, Lisa just said, that's a staggering difference. It is a staggering difference. And yeah, it's kind of a perfect example of relatively recent returns. Okay. The other risk that you have, of course, is longevity risk. So when we had a pension, so whether that was a pension that was issued by a government or a country or, sorry, those are the same thing. When you had a government or a company, it is easier, of course, to plan for the retirement of a large group of people because averages matter. That's why you have actuaries. So an actuary will take a large group of people and estimate when people will die, and they will get it largely right. You can't do that with yourself. So you could be an outlier on either side. You could be an outlier by living a very, very long time, which is a good thing. So you're very lucky that you get to live a very long time. But that's, of course, very bad for your retirement planning and very different. Or you could drop dead the year after you retire, but you don't know. So you can go through, and I just pulled this chart, as you can see, the probability of dying at each age for a 65-year-old man, right? So once you make it to 65, of course, hey, when are people actually going to die? You don't know. Where you end up during this and whatever that probability is, those probabilities would allow us to calculate how much we need for a large group of retirees, because these probabilities will impact when that large group will die. But you have no idea which year you will die during this, or which age you will die during this problem. So this, of course, longevity risk is the risk of dying of dying after you've run out of money. So that's longevity risk. All right, so the retirement dilemma, which we're going to try to solve with this withdrawal rate, is with longevity risk. Anytime risk, there's an uncertainty. So what is the uncertainty? That you don't know when you're going to die. How would you mitigate that risk? Well, the approach to address longevity risk is to make sure you're not too conservative. So over very long time horizons, we, of course, want to invest in more growth assets like shares and less defensive assets like bonds. Why? Because over a long period of time, we will have higher expected returns from growth assets. And the risk that we're taking on for those higher returns is volatility. So the bouncing around, right? Cash, almost no returns, no volatility. It's not going to bounce around in price. Shares bounce around in price every day, every minute of the trading day. They can have large swings during short time periods, but over the long term, you have higher expected returns. So with longevity risk, the risk that we will live for too long, we want to stay invested in shares. So not all in shares, but a good portion of our portfolio in those growth assets. The problem is that sequencing risk. So the sequencing risk says that over long time periods, we know that, as I said before, that you get higher expected returns from shares. The problem is we don't know what they do in the short term. So that volatility of shares actually increases sequencing risk. Because if I invested my entire portfolio in cash, then what would happen if the market went down? I wouldn't care because I know how much money I'm going to have, right? It's the volatility of those shares that is going to cause those portfolio losses. Same thing right here. What caused these differences? The volatility of shares. This was all in cash. It would just be the same. I would have $500,000, I take out $20,000, I have $480,000, et cetera. So as you're probably figuring out, what is the risk mitigation to prevent large drops in your portfolio early in retirement? That you have more defensive assets, because those defensive assets won't bounce around as much in price, which means you won't have those large losses in case the market starts falling early in retirement. All right, the problem is that, as you probably picked up, longevity risk tells us that we mitigate it by more growth assets. Sequencing risk tells us we mitigate it by more defensive assets. These two things are in conflict. And this is the retirement dilemma and the problem that we all go through. Not me yet, although given how today is going, I wish I was retiring. That is the problem that we all face. So what do we need to do? We need a withdrawal rate. So we need an amount that we take out of our portfolio that is sustainable, which means that it enables your portfolio to last for a long enough time to exceed most lifespans. And it needs to make sure that you don't run out of money in most market conditions. All right. So a little bit of probability here. Like if you live to 109, you're probably in trouble. But if we can get something that covers most lifespans and most market conditions that we've seen historically, then we have a safe, a quote unquote, safe withdrawal rate. All right. So let's talk about the 4% rule. So this guy, Bill Bengen, who was a financial planner in the US, in the early 90s, he realized that all his clients are coming here and asking the same question. And once again, like if you think about sort of the history as governments and companies and everything else have shifted the burden of retirement from them to all of us. Think about the 90s, it's kind of when stuff was happening. So, right, just like in Australia, now Bill Bengen was in the US, but same thing happened, right? Moved away from more company-based and government-based pensions to voluntary retirement accounts with tax advantages, so very similar to Australia. So he's getting the same question. So he says, I'm going to calculate this safe withdrawal rate. So what did he do to figure this out? All right. And we did have a question, which I'll get to in a second, that's sort of related. So he decided, I need to go back and look at historic returns. And we'll talk about the problem with historic returns in a second. But he went back and he looked at bond and share returns between 1926 and 1992. So I think he did this in 94. So he was just taking the data set that he had. And he was trying to find a withdrawal rate that would not result in running out of money in retirement using two different parameters. And this is the question. The first one was 30 years. So he defined retirement as 30 years. So he said most people are not going to, if they retire at 65, that they are not going to live past 95. And that is enough. Remember I said we want something that works for most lifespans. Once again, if you live till 109, yeah, you're probably in trouble no matter what. He said 30 years to him in his study, that covers most lifespans. The other thing that he did is he said, of course, as retirees, we are faced with inflation and we don't have incomes that hopefully increase with inflation to protect us from it. So he said that what you were doing is he wants a consistent real withdrawal rate. So remember we talked about nominal and real last week. Real is actual purchasing power of money versus nominal, which is just a dollar amount. So what does that mean? It means that you need to increase your withdrawal by inflation, which allows you to live the same lifestyle, even as inflation takes off. So that is what he set out to do. So what this means in practice is when you retire, you take 4% of the amount of money you have, and then whatever that dollar figure is, so let's say it's back in that $500,000 situation, it's $20,000, then that dollar figure is adjusted every year by inflation. So that's what he means by having a consistent real withdrawal rate. So this was the birth of the 4% rule. And the 4% rule is one of the most important rules in investing. All right, so I think we've got a question to this. So Joe says, assume the withdrawal rate is not adjusting withdrawals for inflation and or maintaining a fixed 4% withdrawal. It's a $20,000 flat withdrawal each year. And is there an analysis adjusting for these factors? Okay, so Joe, I think what you're asking, when I go back to that original slide and I said $20,000 a year, I'm not including inflation in that example. That example is supposed to illustrate sequencing of returns. If we included inflation in that example, both of those figures would go down, right? Because we would be taking out more money. So that was just illustrative of sequencing risk. Here, what we're talking about is sort of what Bill Bengen did. And so the way he came up with this 4% rule is he took every return combination between 1926 and 1992. So what he was trying to do, so basically saying that, okay, between 26 and 92, there were, once again, if we're doing just the order, here are the order of share market returns. Here's the order of bond market returns. He took every scenario. So what he was trying to say is, what if, not like my 2000 example where I just reversed them, what if you happen to retire at the worst time ever? Now, there's no real worst time. There is a real worst time ever, which I believe is in the early 60s. But if you were looking at the worst combination ever, so the worst share and bond returns, even if they didn't occur in the same year, that is what this sort of Monte Carlo simulation that he ran, where he's trying every different combination. So he's saying, I'm looking at all these historical returns in this hypothetical, terrible environment where you had all the worst returns between 26 and 92 happen right when you retire. Would your money run out? And so that's what he did. All right. So the question, of course, is, does the 4% rule still apply? let's talk about the current market environment we're in. And this relates to what I said was the very interesting report that Shani wrote off of some research that Morningstar did in the US. Okay, so let's remember what we did. We looked at historic returns. As you'll probably hear me say over and over and over again on these things, history doesn't matter. All that matters is what happens in the future. The only reason we look at history as investors is because, of course, we don't have anything else to look at. So we might as well look at what has happened before and use that as an estimation to what has happened in the future. But this is called back testing. All right, we hear this term all the time from an investing standpoint. It's back testing. So we are back testing a theory and assuming it will apply into the future. But as you hear, and also in every single investing ad and anything else that goes out there, every disclaimer is that past performance is not necessarily going to happen in the future. It's not indicative of what's going to happen in the future. All right, so we do need to take a look at where we are right now in the current environment. So one thing, bond yields are as low as they've been in 70 years. So what does that mean? Lower bond yields equal lower future returns. Why? Because of course a bond, one element of return is the interest you're getting paid. You're getting next to nothing right now because the yields are so low. And of course, bonds fluctuate in price based on interest rate movements, and they move inversely to interest rates. So if interest rates go up, bond prices go down. If interest rates go down, bond prices go up. Well, if we have really low yields, what's the most likely scenario over a long retirement? That they go up. All right, we're starting to see that right now. That equals lower bond returns. The other thing, of course, we're looking at share valuations. They're just as high as they've been at any period during the last 70 years. So what does that mean? Higher valuations equal lower future returns. So not great for shares. And remember, with the share, you get returns from three different areas. You get changes in valuation levels. Are we likely to continue to see rising valuation levels? Probably not. So if we knock out that portion of returns, then we've got earnings growth. And we've got dividend yield. Well, dividend yields are the lowest they've been ever. So we've got some issues going forward with shares. The third element that impacts the withdrawal rate, of course, is inflation, because you have to put an inflation estimate on all of this as well. So as we had from that question, so when Joe was asking about inflation, we need to estimate inflation. So Bill Bengen had to look at inflation during all those years as well. Now, inflation is historically low, but it is rising, and it's rising pretty fast. So we could do obviously a whole webinar on inflation. If we also, along with something will get adjusted, we'll talk about what that could be in a second. We have low bond yields, high equity valuations, and high inflation. That's sort of a triple whammy, right? So that is three very bad things. Now, generally what happens when inflation goes up is we have adjustments. The adjustment is that when there's inflation, interest rates go up, because interest rates, of course, need to be higher if someone wants to invest in a bond, because they know that their purchasing power is going down. So generally, high inflation is followed by interest rates. We're starting to see central banks talk about and raise interest rates. The other thing that generally happens with higher inflation is equity valuations go down. What does that mean in layman's terms? The market goes down. So maybe these two things will adjust. Neither of those are great, all right, for short-term returns, but that's a possibility. But yeah, so low inflation equals higher withdrawal rates generally, because of course you're not increasing that amount every year. But if inflation is higher, you are increasing it. So in this Morningstar State of Retirement report, which Shani took from the research that was done in the US, suggested when we look at future returns that the 4% rule should be changed to the 3.3% rule. Now, that's not a good thing. What does that mean? Well, the way that we then calculate how much we need per year, when I said we would finally get to a simple piece of math, well, the way that we do that is we divide the amount of money we need every year by the withdrawal rate, and that will give you the lump sum. So simple division there, right? So in this case, and that's why I remember these steps, and we'll go through these steps again in a second, we figure out how much of our salary need, we figure out the replacement rate, we figure out what our salary, we project it to be when we retire, take the replacement rate times that amount, we come up with a dollar figure amount, we figure out a withdrawal rate that we're comfortable with, we just divide those two numbers and we get a lump sum. The problem, of course, is that if that withdrawal rate is lower, mathematically, if you are dividing a same sum of money by a lower percentage, the answer goes up, right? So simple example, if we need $40,000 a year, we divide $40,000 by 4%, we need $1 million. All right. If it's 3.3% withdrawal rate, now all of a sudden we need $1.2 million. So all of a sudden you need 20% more money in your retirement plan. So not great news, all right? But you have benefited if you're about to retire. I know this isn't great news, but you have benefited from years of very, very strong return. So I know that everyone sort of mentally resets. Everything in the past that happened was just sort of deserved and what happened in the past. And then the future is scary and unknowable. But, you know, you have benefited from all those returns. So something important to remember. Difference is like if you retired in 2010, all right, you've had a decade of negative S&P 500 returns in the US. So that's not great, but you're retiring at lower valuation levels, but your nest egg isn't as big. So we just have to realize there are puts and takes in all of this. All right, so what can we do about this? Because this is a really important thing. All right, one thing we can look at is we'll spend some time on this, a flexible withdrawal rate. Now, there are certain conditions that a flexible withdrawal rate works in. We'll explain what it is in a second. One could be if you receive retirement income from non-portfolio sources like the aged pension or an annuity that you can buy. So why do people buy annuities? So an annuity, you pay an insurance company a lump sum of money, and they will give you, depending upon what type of annuity it is, they will give you a certain amount of money for life. So what is that protecting you from? It's protecting you from both sequencing risk and longevity risk. Because if you, in 2000, if you graduated from working, if you retired in 2000 and you bought an annuity, you wouldn't care about market returns. Depending upon who you bought the annuity from, maybe you get a little nervous during the GFC, but you wouldn't care about market returns. So that protects you from sequencing risk. The other thing that an annuity does is it protects you from longevity risk because it will pay you until you die. It doesn't really matter when you die. And that's why people don't like annuities, because everybody, I think, has this fear, as I've said before, that you are going to walk into the annuity office and turn over your giant lump sum that you spent your entire life saving for, and then you walk out in the street and a bus hits you. And that means you get nothing. And the insurance company keeps all the money. But annuities do protect you from both. So what is an annuity? An annuity is basically creating, once again, that pool. Just like I talked about that governments used to do, or big companies with big pension plans used to do, creating that pool of retirees that then allows them to work with actuaries and come up with an average age of retirement. That's what an annuity is doing. And it protects you just like a pension used to protect you or would protect you. It protects you from sequencing risk and it protects you from longevity risk. So that's another factor if you have these non-retirement sources, particularly if they cover your basic expenses. Like if you have the age pension that could, feed, clothe, and house you. Same thing with an annuity. If you took a portion of your portfolio to do that, that's a very good thing. And then we'll talk about how flexible withdrawal rates work on top of that. The other thing, of course, is if you have a lot of money. So it's always better to have more money than less money when we're talking about retirement planning or most other financial planning. If you have a lot of money, and once again, your needs, as we earn more money past a certain threshold, all of a sudden more and more of our budget is taken up generally by our desires versus our basic needs. So yeah, if you have a lot of money, you can consider a flexible withdrawal rate because you'll still be okay. So what is a flexible withdrawal rate? All right, a flexible withdrawal rate basically means that we will change the amount of money we take out of our portfolio based on market conditions. So very simply, and I'll go through a couple examples. Very simply, what this means is that if the market does really poorly, you get less money as a retiree. Now, why don't people like to do this? Well, number one, obviously, we are not used to that. We're generally used to a set salary. And yeah, it's what people are used to. The other thing is a lot of people think the notion that market returns are going to impact their lifestyle in retirement is something that they really want to avoid. So remember those things. And that's why I'm talking about, if you have situations where you have an annuity of a certain fixed amount that you're getting that covers those expenses, your sort of basic expenses, or if you have so much money that your basic expenses are fine, no matter what that withdrawal rate goes up and down. Yeah, some people like that think that it's more tolerable. Now, remember, of course, this could mean things like you are canceling a trip because the stock market goes down, which is frustrating, but not the end of the world. If those things don't apply to you, then it's a little bit different. Then you really want to think about that fixed withdrawal rate, which is what like the 4% rule is, because if you cannot scale down your retirement because it's covering your basic expenses, then you need a fixed withdrawal rate. All right, so what are a couple examples? And in this guide that Shani wrote, go through these in detail. So one thing is you forego inflation adjustments. So what that basically means is on real terms, your lifestyle is going down. All right, so if inflation goes up 10% and you don't change your withdrawal at all, then all of a sudden you are buying 10% less stuff. So basically your lifestyle is going down. The other thing is this notion of required minimum distributions. So basically what that means is you are calculating how much you're going to take out based on how the market moves and how old you are. As you get older, it's part of the formula because you're getting closer to death, right? We're all getting closer to death. But as you get older, you of course can take more out. But if the market goes down, so it's like every year you're resetting with the 4% rule almost, right? So if you have $1 million, the market goes down 50%, you have $500,000, all of a sudden you're taking out half as much money. So that's required minimum distributions. The guardrails method basically just does these same scenarios. If the market goes down, you take out less money, but there is a guardrail that means it does not fall as much, right? So if the market goes down, my example, 50%, you'll only reduce the amount you take out of your portfolio 10%. Same thing if it goes up. If it goes up 50%, you don't get to increase it by 50%, you increase it by 10%. And then just a very simple rule of thumb, every time the market or your portfolio goes down over the course of the year, you reduce what you take out 10%. So these are all flexible withdrawal rates, right? So what we are doing is we are responding to market conditions. And what we're doing, obviously, is we are making our lifestyle very dependent upon how our portfolio does. Our portfolio does really well. Great, we get to spend more money. Our portfolio doesn't do as well. We spend less money. So, this is almost like people that work in a job that's commission-based or like some sort of sales incentive-based, where if you do really well and you sell a bunch of stuff, you get paid more. Then you do really poorly. You don't sell stuff, you get paid less. What do all of these flexible withdrawal strategies do? They all raise the percentage you can take out of your portfolio. So what that means is that first year, I can take out more, and you can see here they all are stacked. And this is based on the Morningstar study where we said 3.3% stacked against all of these different amounts. So fixed real, that's basically the 4% rule, right? So we have a fixed real in real terms, cost of living that we're taking out of, or lifestyle that we're getting out of our portfolio. Inflation goes up, I take more out, et cetera. And you can see every single one of these other ones is above it. And this is like a nightmare to me because I'm colorblind. But you can see this. It's in that report that I was referencing as well. That will be in that email that I'll send the link out. So showing, and you can read more details about these different withdrawal rates. And then you can see, obviously, that all of them, you get to take out more money initially, knowing that in the future, that amount that you're taking out could go down based on market conditions. All right, let's bring this all together. So once again, 4-step process. So the first thing we're doing, of course, is we're looking at income replacement rate. We're thinking about taxes and savings and changes in lifestyle. We're coming up with the percentage of our salary that we want to try to replicate in retirement. Step 2, if you are away from retirement, we need to put an inflation adjustment on there. So an inflation adjustment, basically looking at what is your salary going to increase, or in this case, the lifestyle. If you're very happy with your lifestyle, then what are we trying to replicate there? So put that inflation adjustment in there. Calculate your safe withdrawal rate. And once again, think about the factors that influence your own life. So 3.3% is what Morningstar's study came up with when we looked at current market conditions, our expected future returns, and all of the caveats that were laid out with the 4% rule. And remember, 4% rule, any rule that we use that applies to everybody actually applies to nobody. So you have to think about your own situation, go through every one of those steps and say, every one of those caveats and say, does it apply to me? 30-year retirement, for example. Well, one thing that may not apply to you if you retire at 45, right? So think about early retirements, think about people of a later retirement, people that transition to retirement with part-time work, for example. There's all sorts of different things that people do. So think about how these caveats apply to you, but really understand what each one of those factors means. Then, of course, we just do a little division. So $70,000 divided by 3.3% equals $2.12 million. So just do the division, and you come up with an answer. So yeah, how easy is that? All right, we've got a couple questions and comments. Okay, so Lisa is asking, so Lisa says, where do we find the actual inflation rate in Australia each year? Okay, so this is another thing that's important to think about, Lisa. So where do we find it? We can get the RBA publishes it. So generally the way that inflation is measured is CPI. So there is a consumer price index. That consumer price index is made up of a basket of consumer goods that are supposed to represent what the average Australian spends, the percentage of an average Australian spending that goes to different categories. So I don't have them off the top of my head, of course, but 30% to housing and 10% to gas, petrol, and et cetera. So that's what CPI is. Now, remember, your personal inflation rate could be very different. So Lisa has 3 alpacas. I don't know how much it costs to have an alpaca, or maybe you make money off your alpacas, right? Isn't that the point? You sell their wool. I think it's wool, not fur. Wool. We'll go with wool. So I don't know if alpacas make you money or lose you money, but everyone has their own lifestyle, their own nuances to how they live their life. So you think of your personal inflation rate, but yeah, just look up the RBA statistics and it will go back and it will look at that inflation rate. If you go back a long period of time, the inflation rate on an annual basis in Australia has been very high, interestingly enough. Okay, so Rory is asking, so fleece. Lisa says fleece. So something else you learned today, not just retirement, fleece comes off of an alpaca, not wool or fur. I was pretty sure it wasn't fur, but I would have guessed with wool. Thank you, Lisa. Okay, so Rory's saying, so is the withdrawal rate based on the assumption that the individual wants to retain their capital? So no. So the 4% withdrawal rate means that you are taking that out of your portfolio. So your portfolio can generate income, and also, of course, you can sell off principal. What the 4% withdrawal rate is trying to do is trying to make sure you want to retain some capital for 30 years and support your lifestyle. So it's not, it is not leaving you with anything. Now, remember that 30 years, so very important, that 30 years that Bill Bengen came up with is under a worst case scenario, right? And that worst case scenario is retiring into very, very poor market returns. But the problem is, right, that as I said, this is zero-sum game. So if you make it through the first 10 years, and that's probably being a little conservative, so maybe a little bit less, but if you make it out of, let's say, the first 10 years of retirement in a very good market, then you are fine. Like with the 4% rule, yes, you will likely die with a lot of money. So someone who retired 10 years ago at this point is in really good shape because we've had really, really strong returns. So yeah, remember that's a worst case scenario, but we are being conservative here because the outcome of running out of money before you die is such a bad one. So retirement savings is really about being conservative because we don't know future market returns and we don't know when we're going to die. See, I did say death a lot today. So we're going to try to have a less morbid one next week. All right. All right, so I'll share my email address. Somebody asked in the chat. There we go, multitasking. Oh, and Shani already wrote it. Okay, well, thanks, Shani. Shani, if you're going to give out email addresses, you should give out your email address. Okay, so John has a really good question that I should have answered. So compulsory current minimum withdrawal rates from super are much higher than 3.3%, increase as you age. How does this affect your calculations? Well, simply it doesn't. So just because you take money out of super does not mean you need to spend it. So what we are saying is don't spend the money. So you can very easily take money out of super, put it into a taxable account. But yeah, there's a government mandate. And then there is what we are trying to accomplish, which is very different than the government, a safe withdrawal rate. The government, of course, is trying to get money out of a tax-advantaged account, make sure people are not, quote unquote, hoarding it in there. We're trying to do something different with the safe withdrawal rate. So we're not looking at, and every country has this. I can speak to the US, obviously. Same thing with the US. There are required minimum withdrawals out of retirement accounts, but those are not based on safe withdrawal rates. They're based on government policy. So Sally's saying, does Morningstar say retirement assume 50% bond and 50% cash? 50% bond, 50% shares. Yes, it does. So that's what Bill Bengen used, and that's what we used. Now, in that state of retirement report, they will show you lots of different asset allocations. So yeah, go look at that. One thing I will say is everyone thinks, and listen, it is pretty. There aren't people out there that generally that have 50% bonds, 50% shares at this point because bonds have such a low interest rate. But what the report does point out is, and you may think, okay, so longer term, as I said, for longevity risk, I want to be invested in shares because they have higher expected future returns. If I'm planning for a very long retirement, isn't that what I want to be in? So the volatility, the risk that you get from the volatility in shares, sequencing risk, generally, according to this report, according to people that are a lot smarter than me, if you get 10% returns or higher, then that will compensate you for the extra risk associated with like a 90% share portfolio or even 100% share portfolio. Problem is, we don't think that returns will be 10% a year going forward, given the environment we're in now. Now, have they been? Yeah, they have been. We go back and look since the GFC, but yes. So that's what we're assuming as a baseline. But you can go and look in that report, and you'll see different asset allocations. So Malcolm's saying, in general terms, hasn't been found that the inflation rate for retirees is higher than CPI. Healthcare costs rise much faster than CPI. That's why you need to look at the basket. One thing that I will say is, yes, healthcare certainly hits retirees higher. For some retirees, housing costs, which have gone up a lot, don't affect them as much because they may own their home outright, right? So like I rent my apartment, and I assume that I'm about to get a very large rent increase given sort of what's happening. So that's something that would not affect you as a retiree if you own your house outright. So yeah. So Chris is saying, what about your buckets? So yes, buckets. So the bucket method is one way that you can alleviate sequencing risk and longevity risk. We're going to cover buckets in lesson 8. So you have to wait for that. But if you want to read more about the bucket method, send me an email. I can point you towards some material. At the bucket method, what that basically means is that we are trying to insulate our portfolio from short-term volatility by having cash that we'll use to fund withdrawals when the market goes down. So remember, that sequencing risk, the market going down. So we have a cash bucket. We're using that to fund withdrawals so we don't have to sell assets. So the bucket portfolio method is a way to combat sequencing risk and longevity risk, because you've got a cash bucket, then you've got money invested into growth assets. So hopefully cover you off longevity risk. So I'll just keep answering the questions. I don't think I have a meeting now. So if everyone wants to hang for a second, you obviously are free to leave. This is not school. Yeah, so we've got another question. Since withdrawal rates for super are 4% or higher, and if that is the main retirement portfolio, how do we have a flexible withdrawal rate? Well, so in that case, right, the flexible withdrawal rate means there's a legal limit that you need to take out, but you don't have to spend the money. So what we're talking about is spending money. So, a simple example of how you would do that and sort of how you would want to do that from a tax situation, right, where we want to shelter assets that would have higher tax bills. So income and, of course, capital gains, we'd want to shelter that in a super structure. So what you do is that if the government tells you that you have to take out 5% and you have a 4% plan, well, you take out the 5%, take 1%, throw it in cash. Keep your cash bucket outside of super, and you're not going to pay basically any taxes on that anyway, especially given what we're getting on cash. So you keep that 1%, you spend 4%, and then you're just going to build up that cash bucket. So cool. So given your 2.2 million to provide 70,000 notice implies $800,000 from outside the 1.6 pension cap. What are the implications here? Yeah, so listen, the other problem obviously with super is that there are tax consequences of having more than $1.6 million. So what that is, like the simple way, and obviously I can't answer tax questions for everyone. The simple way that you fund that is you have to take taxes into account. So when we're talking about a withdrawal rate, remember, we are assuming that that is after taxes. If you have to pay taxes on that, you need to add it to the amount. So you need more money outside of that $1.6 million pension cap to fund the taxes you would have to take out. Super, good thing about super, obviously, below that cap, they're tax-free withdrawals, but you'll have to take taxes into account. So you would need that extra money to be after tax, right? Just the same way that we would go into paycalculator.com, Shawnee's favorite website. If we wanted to go in there and put in, somebody offers you a new job, like in Shawnee's case, with her job hunting, if somebody was going to offer her a new job, she could go in there and say, oh, they're willing to pay me X amount. She would put it in, then she'd see what her take home was, right? And say, oh, okay, so even though they're paying me more because of higher taxes, I actually only get this much more in take home. So it'd be the same thing. So you basically have to do that. All right, what else do we have here? Someone just said hi. So hi, Peter, thank you. If a market crash is going to happen, would you withdraw anything? So Polly's asking that. Well, if I knew a market crash was going to happen, I guess I would, but of course I don't, and nobody does. So yeah, we need to obviously take that into account. So Peter's saying calculating the lump sum required for 3.3 withdrawal rate seems to me there's an assumption that real returns will simply match inflation. Is that not overly conservative? Listen, I would say that all of this is conservative. What is the risk that what is the risk that you're protecting yourself from? You're protecting yourself from the risk that you retire at a really, really bad time and have very bad luck. So all of this is conservative. The problem is that when we approach retirement, I think a lot of us want to be conservative because having that outcome of running out of money is not something people want to face. So yeah, I would say all of this is conservative, but that retirement planning is conservative. All right, so I think and thank you for the compliment, Peter. Okay, so Sofin said, I did not get an email after the first webinar. Let me take a screenshot of your name and I will double check it and I will get it out to you. Yeah, we will, as soon as we get the video processed and published, we'll send it out, hopefully today, maybe tomorrow morning. We sent it the next day. So if you're looking last week, it actually came out Wednesday morning because it took us a little time to get the video processed. But Sofin, I will get back to you. And also saying, are there a chance to get tickets to your investment conference? Yeah, if anyone wants tickets to our investment conference, oh no, now we have 2 people. So now you're making my life complicated. I'll take a picture of the screen. How about that? Look at that, all forms of technology. Yeah, if anyone wants to come to our conference February 3rd, send me an email. I'll get you a very cheap price on a ticket. And another person didn't get it. Okay, now we're just having problems. If you'd like to come to our conference, it is now online. Apparently there's a COVID outbreak. Nobody told me, but yeah, we're gonna do it all online. Everything will be recorded, kept for 30 days. If you want a ticket to the conference, we have a bunch of great speakers. I'll MC it, so I try to be funny, which will be exciting for everyone involved. But just send me an email, I'll get you a cheap ticket. All right, so we've run over time, 3:07. Sorry about that. Thank you guys. Another person. All right, I'll get back to you guys. All right, thank you very much for joining. I appreciate it. I will see you all soon.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.